Welcome to the Deep Dive. Today, we're jumping right into Pentair's Q3 2025 earnings release and their presentation materials. They're a big name in sustainable water solutions.
Absolutely. And we're really going beyond just the headlines here. Pentair's got those three segments: move, improve, and enjoy water. And we want to figure out, what's really driving their growth and maybe more importantly, their profitability.
Right, and the timing, this is all based on their Q3 performance, which they released, October 21st, 2025. So very fresh data.
Exactly. And just to give you a sense of scale here, Pentair did about $4.1 billion in sales back in 2024, heavily weighted towards the U.S., about 70% of sales.
And they have that dividend aristocrat status too, right?
Yeah.
It's like 49 straight years of dividend increases.
Yeah, 49 consecutive years. It really signals a certain discipline, I think, and that makes their current focus on operational efficiency even more interesting to watch.
Okay, let's get into those Q3 2025 numbers then. The overall results compared to last year. What did we see on the top line?
Well, total sales came in at $1,022 million. That's up 3% year over year. And core sales, they also grew 3%. So, solid, not spectacular growth.
Okay, 3% top line. But what about profitability? That often tells a different story.
Yes. And this is where it gets really interesting. Adjusted operating income was up 10% year over year, hit $263 million.
10%. Okay, so definitely outpacing sales growth.
Definitely. And that pushed adjusted EPS up 14% to $1.24.
Wow, okay. 14% EPS growth on just 3% sales growth. That's some serious leverage they're finding. How'd they manage that?
Look at the margins. Adjusted return on sales, the ROS, it expanded by 160 basis points. That's 1.6 percentage points, hitting 25.7%.
It's a significant jump in margin.
It is. And actually, these figures, the adjusted operating income, the ROS, and the adjusted EPS, they all set a record for the third quarter since they split off nVent back in 2018.
Right, the nVent separation. So this is the focused, pure-play water company really hitting its stride on efficiency.
Seems like it. They're really delivering on the bottom line, even without huge revenue increases. And while they were focused internally, they also made a move externally.
The Hydrostop acquisition, that was in September, I think.
Yeah, September 17th. Paid $292 million for it. It's aimed squarely at beefing up their commercial flow business, think pipes, valves, water, main stuff.
Makes sense strategically. Was it a good deal financially?
Well, the materials mention an expected tax benefit around $50 million related to the deal, so that certainly helps the economics while they strengthen that commercial side, which is, less tied to maybe the residential ups and downs.
Okay, so overall picture.
Yeah.
Moderate sales growth, but really strong margin expansion driving record profits. Now let's break it down. Did that efficiency show up everywhere, or were some segments pulling more weight?
Good question. Let's look at the three segments: move, improve, enjoy water, and see where that 14th straight quarter of margin expansion came from, starting with flow or move water.
Right, the pumps, valves, the basic infrastructure. How did flow do?
Flow looked pretty strong, actually. Sales were up 6% year over year to $394 million. Core sales grew 4%.
And where did that strength come from within flow?
It was pretty broad, really. Residential was up 3%, commercial up 5%, and industrial solutions, that was the leader, up 10%.
Okay, solid growth across the board there. And margins.
Followed suit. Segment income for flow jumped 15%. That pushed their ROS to 24.2%, which is 200 basis points higher than last year. So yeah, the core business of moving water seems to be doing quite well.
All right, one strong segment down. What about water solutions, the improved water segment, filtration, softeners, that kind of thing?
Okay, now water solutions is a bit more complex this quarter, but it really highlights their strategy. On the surface, Q3 sales were actually down 6% year over year, coming in at $273 million.
Down 6%. That sounds like a potential issue, especially in improved.
It does, but there's key context. The sources point out that decline included a pretty big hit, negative 9%, from a business exit they completed back in Q2.
Okay, so if you strip that out.
If you strip that out, core sales were basically flat, just 0.5% growth. So essentially holding steady on the underlying business after managing that exit.
Flat core sales. But what happened with profit in that segment? This feels like a key test case for their efficiency drive.
Exactly. And this is where it's quite remarkable. Despite flat core sales, segment income for water solutions was up 6%, and the ROS hit 25.0%.
Wait, up 6% income on flat sales. How much did the margin expand?
A massive 280 basis points, almost 3 full percentage points.
Wow. So How did they pull that off with no real sales growth?
This is the transformation program shining through. The sources are clear. They use pricing actions effectively to counter inflation, and they realized significant savings from that transformation initiative. It flowed right to the bottom line, basically offsetting the sales pressure. Real self-help there.
Okay, that's a powerful demonstration of internal controls. Now, the third segment, pool or enjoy water. Usually their highest margin business, right?
That's right. And Pool had decent top-line growth. Sales were up 7% year-over-year to $354 million, and core sales were up 6%. Pretty good coming out of the main pool season.
And the margins in pool, still leading the pack.
Still the powerhouse, yes. ROS was 32.8%. I mean, that's huge. By far the highest margin segment they have. However,
There's always a however.
yeah, it was actually down compared to last year. The margin contracted by 120 basis points.
Down 1.2% points in their most profitable segment, even with decent sales growth. What's the explanation there?
The context given was that the prior year, Q3 2024, saw this enormous ROS expansion in pool, nearly 500 basis points. So the comparison bar was incredibly high.
Okay, so maybe just normalizing a bit.
Partly normalization, but also partly intentional. They flagged that the current figures reflect deliberate investments in growth initiatives within pool.
Investments, like what? R&D marketing?
Probably a mix. Things like new product development, maybe shoring up the supply chain for pool equipment, definitely expanding their digital and connected pool offerings. They're likely spending a bit now to secure future growth and maintain that segment leadership.
So a calculated trade-off. Sacrificing a bit of margin now for longer-term strength in their cash cow segment.
Seems to be the strategy. You can't expand margins by 500 basis points every single year, right?
Fair point. Okay, this whole conversation, especially with water solutions and even pool, really points toward their internal efforts. Let's talk about that engine, the transformation program, and this 80-20 thing they mentioned.
Yes, this is absolutely central to understanding how they're posting these results. This internal program is the bedrock, especially when, some markets are a bit soft.
So what are the key parts, the pillars of this transformation program?
They lay out 5. Pricing excellence, we saw that in water solutions. Sourcing excellence, getting better deals on what they buy. Operational excellence, making things more efficiently. Organizational effectiveness, streamlining how they work. And then there's the digital enterprise / complexity reduction piece. That's where 80-20 comes in.
Right, 80-20. We hear that term a lot.
Yeah.
What does it mean practically for a company like Pentair? Are they just, firing 80% of their customers?
No, not quite. It's about focus. Based on the Pareto principle, right? The idea that roughly 80% of your results often come from 20% of your efforts or products or customers.
Okay.
So Pentair is likely using this to identify, say, the low-volume, low-margin products that take up a lot of factory time or management attention or maybe complex customer accounts that aren't very profitable. And then they strategically simplify, maybe discontinue those products or change service levels, focusing resources on the 20% that drives the real value.
Streamlining to maximize profit from their winners.
Yeah.
Makes sense. And is it working? Are there numbers on the savings?
Oh, yeah. The sources quantify it. They said the program delivered $174 million in savings, net of the investments they made in it, just across 2023 and 2024.
$174 million. That's substantial. What about this year, 2025?
They expect to get about $80 million in savings, again, net of investments, for the full year 2025. And year-to-date, as of Q3, they had already banked $56 million of that. So it's an ongoing, measurable benefit.
And this consistent saving, this efficiency drive, that's what's giving them the confidence to aim higher long-term.
Exactly. It directly led them to raise their long-term target. They're now officially aiming for 26% ROS return on sales by the fiscal year 2026.
26%. What were they back in 2022 for comparison?
In 2022, their ROS was 18.6%. So hitting 26% would mean expanding margins by over 700 basis points in just 4 years. That's a huge transformation.
It really is. And you mentioned earlier that some markets are soft.
Right. And this is key. They're achieving this margin expansion without really getting the full benefit of volume leverage yet. Especially in residential markets, things are still a bit sluggish due to, broader economic factors.
Does the fact they're expanding functions now, mainly through these internal pricing and productivity actions, is even more impressive? It's not just riding a wave of demand.
Precisely. It's a lot of self-help driving the results right now. Imagine what happens when volume does pick up more consistently.
Okay, let's shift gears slightly to the overall financial health. Balance sheet, cash flow. How does that look?
Looks very solid. They generated record free cash flow year to date. $719 million. That's up $90 million compared to the same period last year.
Strong cash generation. What are they doing with it?
Continuing to return cash to shareholders, they've repurchased $175 million worth of shares so far this year, and their debt levels look quite manageable.
What are the metrics there?
Net debt to EBITDA is low at 1.3 times, and their return on invested capital, ROIC, is strong at 16.7%. They're actually targeting getting that into the high teens over the longer term.
So financially stable, generating cash, managing debt well, but it's not all smooth sailing, is it? There are external headwinds, particularly tariffs.
Yeah, that's a big one. The sources detailed the expected impact for 2025, and it's not trivial. They estimate the total incremental hit from tariffs this year will be around $75 million.
$75 million just from tariffs. Where is that coming from?
It's a global mix. There's the ongoing 30% tariff related to China, which is about $30 million of the impact. Then 25% on certain goods from Mexico, maybe $10 million. The EU adds another $10 million at 15%. And then you've got tariffs on raw materials like steel, aluminum, copper, averaging around 25%, contributing another $15 million or so.
Wow, that's a complex web of costs hitting them from multiple angles. How do you absorb a $75 million hit and still expand overall margins by 160 basis points?
That really underscores their operational execution, doesn't it? Management stated they expect to fully offset that $75 million impact.
Fully offset it. How? Just price hikes.
A combination. Pricing actions are definitely part of it, passing those costs through where possible, but also, importantly, through mitigation strategies in their supply chain.
Like what kind of strategies?
Well, they specifically mention reducing their reliance on sourcing from China. And for Mexico, they highlighted that about 85% of the goods they import from there currently qualify under the USMCA trade agreement, which shields those goods from some of the tariffs. So they're actively working the supply chain routes and agreements to minimize the damage.
That's proactive management, not just accepting the hit.
Right, they're navigating it.
Okay, so given they seem to have a good handle on costs, both internal efficiencies and external tariffs, it probably shouldn't be a surprise that they raised their guidance for the full year.
Exactly. It shows confidence. They nudged up the full-year sales outlook slightly, now expecting growth of around 2%.
Still modest top-line growth, consistent with Q3.
Yes, but the key was the earnings guidance. They boosted the adjusted EPS range to $4.85 to $4.90. That represents expected growth of 12% to 13% year over year.
So they're basically locking in that double-digit earnings growth expectation, largely driven by the margin performance we've been talking about.
That's the takeaway. They've demonstrated they can control costs and drive profitability, which seems to have de-risked their earnings outlook for the year, even with ongoing market uncertainties.
So wrapping this up, what's the main thing you, our listener, should take away from this deep dive into Pentair's Q3?
I think the clearest message from the sources is that this is a company leaning very heavily and successfully on its internal playbook right now. The transformation program, the 80/20 focus, strategic pricing, these are insulating margins from, well, pretty much everything thrown at them. Softer residential demand, tariffs, inflation. They're proving they can expand profits even when sales volumes aren't booming.
They've definitely built a resilient operational model. So here's a final thought to consider. We know their strategies about capturing those long-term water trends, scarcity, quality, sustainability, and driving profitability. Looking ahead, as they push towards that 26% ROS target by 2026, which of those three segments, flow, pool, or water solutions, do you think is best positioned to really accelerate growth disproportionately once some of these economic headwinds, especially residential, eventually ease up and they start layering volume leverage on top of this already impressive margin structure? That might be the key to unlocking the next phase of their story.